Hey, what's up, my friend? Welcome back to today's episode where you'll learn, right, how to become a winning, profitable trader, guaranteed. I know that's a strong word to use, right? But you'll understand why later on. So, when you want to find success in trading or anything that matters, whether it's business or whatsoever, right? You must have a framework. You can't just go in blindly, and then start shooting arrows and hopefully you hit something. That's not how it works. All right? It's kind of like me, right, giving you a map and a compass. And I tell you that in the map, right, the spot X in the map, right, you will find treasures, $10 million, yours for the taking. Now, let me ask you, if you just have a compass and a map on hand, how confident are you, right, to reach that $10 million on first try? Well, probably not, right? You would more likely, go towards the direction of the $10 million. You encounter an obstacle, maybe like a big hairy monster in your path, right? And you need to backtrack, right, and avoid fighting the monster. Maybe you encounter a huge mountain that is so high that you can't climb and you got to skirt around it. And, find ways to overcome these little obstacles in your way. And every obstacle that you overcome brings you closer towards the goal, right, at $10 million. And this is the same for trading. You will face obstacles in the way, and you got to find ways to overcome it, circumvent things, right, and improve on your processes, right, before reaching your end goal. So let me share with you a framework, right, that accomplish this for you. So the framework is what I call the D.E.R.R framework, D.E.R.R. Let me explain. D stands for develop your trading plan. That's one. Develop your trading plan. So before you put on a single trade, you got to define your plan. You define your strategy. This means, right, you got to identify the market conditions that you're trading. Is it trading in a trend, trading breakouts, trading pullback, etc.? Then define the entry condition. How will you enter the trade? Limit order, market order, stop order. Then you got to define your exits. How will you exit the trade? Is it a swing trade? Is it a trend following trade? You got to define the markets you're trading. Is it FX? Is it stocks? Whatsoever. You got to define, right, your risk management. How much are you risking per trade? You can see that all these questions, right, will form your trading plan. And that's the first thing you need to do. A consistent set of rules to follow, which is your trading plan. Number two, you must execute your trades consistently, right? And get a minimum of 100 trades. The reason is because, right, in trading, 1 plus 1 may not be equals to 2. You're not dealing with certainty over here. You're dealing with probability. So it's more like 1 plus 1, 60% of the time it might be 2. 40% of the time it might be number 20. I know that's a little bit of, confusion there, but you kind of get my point. You're dealing with probability in trading, right? Nothing is certain. So this is why you need a large sample size of trade, right, to find out whether a trading strategy works or not. Okay, so minimum is 100 trades to execute it consistently. Because if you don't have a large sample size of trade, let's say you only have a sample size of, 7 or 8 trades, it could be that you're in a losing streak at the start of your trading. And after 5 or 6 losses, you claim that it does not work and you abandon the strategy. But the behind part, maybe the next 90 trades, right, you will realize that that strategy actually makes money in the long run. It's kind of like having a coin in your hands, right? Every time it comes up head, you win $10. Every time it comes up tail, let's say you lose $5. Let's say the first 5 coin toss you toss is come up all tails and you lost like what, $25. Are you going to stop tossing that coin and say that coin is cursed, it's not working? No, right? Because if you know that if you have an edge in the markets, right, you need to toss that coin, right? Maybe, 100 times, 200 times, right? Before your edge can play out. And this is the same for trading. You've got to let the law of large number work in your favor, right? Execute your trades, right, a minimum of 100 times before you conclude whether the trading strategy works or not. So that's number 2, executing your trades consistently. Number 3, right, you want to journal down your trades. This means that every time you put on a trade, you got to, write down, right, whether it's a winning trade or a losing trade. You got to screenshot the charts, right, where you enter, where you exit the trade. All right, what's the profit or loss on the trade? Let's say, you risk $100 on the trade. You make $200. That's a profit of 2R, right? 2 times your initial risk. So write down there 2R. Maybe you took on a trade, it's a loss, right? A loss of, let's say, $50. So that's half of your initial risk amount. So you put a loss of minus 0.5R. So what you want to do is to record down your trades so you have a matrix that you can track. Okay? And number 4, finally, what you want to do is to review your trades, right? Find out, right, whether a particular trading strategy is making you money or costing you money in the long run. So let's say you have executed 100 trades, right? Right now, you know what is your ratios, what is your winning rate, what is your average risk to reward on the trade, right? And if you find out that, hey, this strategy actually, is not so profitable, maybe it's just like, break even, mediocre, what you can do is to look at the charts that you have saved earlier and ask yourself, right, among all the 100 charts out there, are there certain patterns that lead to your winners, right? Maybe there are certain things that the chart, there's certain patterns that realize that actually lead to a higher probability of a win. And also, are there certain patterns, right, that every time it occurs, right, it tends to lead to a loss? So once you ask yourself those two questions, you want to avoid taking those trades, right, which have a lower probability of success, and focus on taking those trades that has a higher probability of success. Okay? Once you've done that, right, you can go back to the drawing board, your trading plan, and make the necessary tweaks and adjustments, and go back on to execute those trades, record, and review once again. And this is the framework that I'm sharing with you, right? I can guarantee you that if you follow this framework, right, there is no reason, right, you are not a consistently profitable trader. Is it difficult? Is there work involved? Yes, there's work involved. It's tedious, but this is the way it's done if you want to be a profitable trader. And mind you, this is coming from a discretionary trading point of view, right? Systems trading is a different thing altogether. And if you're interested, right, we can talk about that in another episode. So with that said, right, quick recap. The D.E.R.R framework, number 1 is develop your trading plan. Number 2, execute your trades consistently. Number 3, record your trades. And number 4, review your trades. So with that said, I have come to the end of today's episode. If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel, the button is below, and I will talk to you soon.